So my name again, Van Hesser. I run our corporate rating and financial institutions ratings business. I'm at KBRA, and just to sort of give a little bit of context, I'm going to go through kind of our own view of where it stands, and honestly squares up with a lot of the comments you sort of hear today, which means that there's plenty of uncertainty out there. We worry about shock, but we're still at a reasonable point in the credit cycle, and it's all about trying to forecast when you think that economic downturn is going to happen. So the context, again, which a lot of what you heard today really is a long expansion, accommodative central banks. It's created an environment of complacency, right? 10 years of doing this, it's hard to find people who can remember the GFC, except for the Australians, apparently. The second point here, again, global QE, right? That central bank intervention drove massive growth in credit markets. You've seen all the graphs and intensified the global search for yield. So those two things together, lots of issuers, lots of companies issuing a lot of debt into a market that increasingly sort of held their nose or looked the other way or did whatever they had to do to sort of buy it. So that's where we stand today, context-wise. The current state of affairs as we see it, the consumer, delevered, employed, confident, right? 70% of the economy driven by the consumer. As long as that holds up, we watch confidence a lot, and everything that goes in confidence, we pay particular attention to signals coming out of our asset-backed business, right? That's where we see across all of the consumer borrowing categories activity that really informs our view on the consumer, and all of that feels reasonably good right now. On the commercial side, profitable, right? So we've had very profitable, healthy cash flows coming off of the bests, but that's okay. We would put the leverage story into the manageable category, right? So yes, lots of companies have issued lots of debt. Overall, the degradation we've seen really through investment grade in particular is very real, but remember, right, a lot of that debt was raised at very low interest rates. The ability to service that debt remains, we think, very, very solid. So yeah, late cycle, lots of debt out there, but the leverage risk, we think, is fairly manageable. And again, deteriorating confidence. So there's parts of this that don't feel really good. You look at the ISM data or anything else you want to look at on the commercial side, that does reflect, right, some of those geopolitical risks, right? Tension, trade tensions, China slowing, Europe slowing or slow. All of those things, right, are very real and clearly have flowed through to commercial business managers. And that's a big part of all of this. Not probably as important as a consumer, but something we still pay a lot of attention to. And again, we mentioned that the financial system, really a source of strength, big change from 10 years ago. Now, if we broaden it out to beyond the banks, right, so we've got all that shadow banking stuff that proved for a very healthy discussion, certainly in the last panel, really throughout the day. The ability for the financial system to shock absorb the shock is something that I think we'll talk a little bit more about in this panel. But in general, we feel pretty good about it. So the risks, geopolitical. I hate to sort of hide behind that thing because we all sort of say it, but really these are the things that are driving sentiment, right? The rise in populism, a destabilizing world, trade tensions, oil, all of that just introduces lots of places where that shock can come from, right? So we think about that really not so much in trying to predict this one or this one or this one, but taken together, there's an awful lot of things out there that could produce that shock that some of us worry about as being the thing that tips this over. China, right? China is just unpredictable. So you've got the issues clearly on China slowing, a financial system that has, you know, an awful lot of problems. And then you've got trade tensions. So, you know, as China goes, this is going to go, right? So we've got to be always mindful and paying attention to what's happening in China. And of course, liquidity, right? So Charlie Himmelberg, if he's still here, liquidity is the new leverage, right? I wrote that down. I've been thinking about it for a long time. If you think about, you know, if you remember 2008 and 9, if you think about where we are today, the ability to digest shocks or absorb shocks and problems, that's going to be debatable, right, all around sort of the liquidity issue. One thing I'm going to mention, the way we look at sort of corporate credit is just try and think forward, right? Maybe a little unusual for a rating agency, but we aspire to do that, both be unusual and also think about the future. Technology has just revolutionized everything, right? So we think about it in ways, and again, not speaking about the technology sector so much, but how does technology affect this particular industry or that particular industry? Obviously, you can run the gamut from it is, has revolutionized brick and mortar retail. That's not been a good thing, right? Alternatively, some of the things we see on the energy side, a seemingly permanently out of favor sector is really being revolutionized, right, by technology and technological developments, lowering that cost of production. All of that we think is a real positive. So we try and think through the impact of technology in kind of everything we do. So where does it all sort of add up? Room to run, right? So if I were to think back to this morning, my view on a recession probability, I'm probably on the more bullish end of that, so call it 1 in 4, 25% or so. A lot of that has to do with consumer, and a lot of that has to do with consumer sentiment. There certainly are a lot of things out there we worry about. So diminishing room for error, right? We're not growing at 3% anymore, we're growing at 2%. It doesn't take much to sort of drop you down to 1.5, 1.25. And I've always said once you get below 2%, it can become a self-fulfilling prophecy, right? So risk takers are less likely to take those same risks, whether you're an investor, whether you're a consumer, whether you manage a business. All of that, as people cocoon, if sentiment deteriorates on a macro basis, we worry about that. And of course, vulnerable to shock, right? A couple of things that underpin our view. The best place to spot the excesses today is check what worked out the last time and proved durable through the last downturn, right? So we're pretty sure that the source of the problem the next go around is not going to be the consumer. It's not going to be banks. It's not going to be residential housing. What did do reasonably well in the last go around is what we're probably all talking about today, and that is corporates, whether it was on the structured credit side. Certainly CLOs sailed through the last crisis in really good shape. But we do worry about all of the debt that's been raised and the vulnerability that that's going to have. And as Ed talked about early, the digestion, right, the ability for the high yield market to absorb all that probably makes this a bumpier ride than the last time. So again, we think about uncertainty and all the place it can come from. Again, I'm not going to try and predict any one particular place, but uncertainty creates volatility. It undermines sentiment. It drives growth from 3% to 2% or to 1.5%. That's what we really worry about at KBRA from a credit perspective. Now, with that, I'm going to, I don't know, I think I might have blown this up. Oh, there we go. Thank you, Doug, wherever you are. A truly distinguished panel today, and the variety of perspectives, I think, is really phenomenal. So, really covering the waterfront from an investor's perspective. Investment grade, leverage loan, high yield bond, alternative asset manager, public credit, private credit, fundamental view, quantitative view, all rests in 100 years or so of experience sitting before you, a terrific group assembled, and wow, lots to chew on. Thinking through all of the viewpoints, academic and practitioner today, here's where the rubber meets the road. Where are investors truly putting their money? How do you position in this kind of market? I'm going to let each panelist introduce themselves, probably the easiest and shortest way to sort of get through it, and probably most interesting. So, Vishy, do you want to start?
Thanks very much. I don't know how you got the 100 years, but I'm only 21.
Much of it's here.
Yeah. I'm Vishy Tirupattur. I run fixed income research in the Americas for Morgan Stanley. I'm also responsible for quantitative research, both in fixed income and equities across the globe for Morgan Stanley.
I'm Rachel Golder. I'm one of the leaders of the high yield and bank loan platform at Goldman Sachs. I contribute more than my fair share of that 100 years. And the one thing I will check in is that this morning when I was telling my boss that I was coming to this conference and he looked at the presenters list, he said, wow, there are a lot of ex-Goldman people on this panel. I said, are you telling me something?
Good afternoon, or almost evening. I'm Millwood Hobbs Jr. I couldn't speak on my name at the time, but it's worked out. I grew up in Deutsche, Goldman, leveraged finance, and been at Oaktree almost 7 years and focused on structuring and originating mainly private credit deals within our firm.
Good afternoon, Roberta Goss, and I, like Rachel, contribute a good chunk of the 100 years. I've spent about 30 years in leveraged credit across high yield and leveraged loans, both on the buy side and sell side. I spent about 14 years at Goldman, managing loan and high yield assets. And currently, I've been 2 weeks at Pretium Partners, which is a $12.5 billion hedge fund exclusively focused on credit, be it mortgage credit or corporate credit. And over the last 5 years, I have issued about $5 billion in CLOs, all invested in corporate loans. So I think that's, based on the last panel, a focus of a lot of questions and concerns in the market. So hopefully I can help to answer some of those questions.
Terrific. Thank you, one and all. So why don't we sort of cut to the chase here and go down the line, and where do each of you think we are in the credit cycle at the moment, and maybe give a couple of things that you're focused on that sort of underpins that view. Vishy, you want to start?
Sure. So we are decidedly in the late cycle camp, both from an economic cycle perspective as well as the credit cycle perspective. We expect that from now till end of the year, spreads will be across the credit spectrum, investment grade, high yield, leveraged loans. Spreads will be wider. So I don't have any. If you're not already depressed enough, I'll have more stuff to add. But then I just satisfy myself that we are bond people. We're not equities people. We are credit debt investors. We are happy if we get our money back. That's all we are shooting for. But I think the things that we are, that we would focus on, to underline our view. Some of those things have been touched upon in the past panel. Leverage, the growth of leverage, which was enabled by, as you just said, by the global QE, created all conditions necessary for for companies to lever up, and not surprisingly, the reaction function of the corporations has been precisely that, to increase, put on leverage. So the amount of leverage that we see across the system in investment grade, in high yield and leveraged loans, is at levels that at or near historical highs. There are a couple of blips here and there in terms of we're looking at gross leverage or net leverage, but still at a very high leverage levels. That is certainly something it concerns us. And we look at also earnings growth. In the last few quarters, we have been certainly in a negative earnings growth. If you look at S&P 500 earnings, we had a negative earnings growth in Q1, negative earnings growth in Q2, and we expect a negative earnings growth in Q3. So if you think of leverage as debt to EBITDA, debt does debt stays, EBITDA keeps going down. That concerns about leverage keep going higher. That's certainly it's a major concern. The other thing also mentioned in the last panel has to do with not so much the covenant light portion, but the quality of individual covenants. And the quality of individual covenants and the consequence of that for loss given default is a very meaningful. It's very meaningful. And most CLO people will tell you there is a base case of CLO that all CLO people consider: 2% annualized defaults, 75% recovery, 20% prepayment rate. And as I think in the previous panel, what you were mentioning before, I think a meaningfully lower recoveries is something we think will be the consequence in the cycle. As a consequence of that, we think we will have a lot of these underlying assumptions on which some of the structures have been built. That actually is a significant issue. Those are the things that we are watching to make our view.
We're a little bit more bullish than most of the people I've heard today at Goldman, acknowledging that we're 10 years into a cycle. There's a lot that's really unusual about where we are in this cycle. We've already had central banks globally linking arms, singing Kumbaya, let's lower rates together. That is keeping investor confidence relatively high that central banks are going to continue to do that, and that's keeping them invested in the markets. Also very rare at this stage in the cycle to see relatively few individual asset class bubbles building or sector level bubbles building. And in fact, from the high yield bond perspective, and you will have seen on Oleg's chart, actually, high yield bond assets outstanding have been shrinking where they've been growing elsewhere. So it is ironically one of these more protected subgroups within this. But a reset button was really hit in the high yield bond market through the energy recession of 15 and 16. There was a real pickup in defaults in the energy sector, shut down access to capital for most high yield companies. Corporate managers said, oh my goodness, let's learn a lesson from that. Let's not get out over our skis in terms of aggressive behavior. You've also seen in the last year and a half a significant amount of uncertainty about trade and tariff behavior. That's kept companies from doing things that were exceptionally aggressive. Now, I will say that we are seeing slowing growth, very much as Vish said. We're more than a year into the tax reform, so the tax reform tailwinds have faded, and we're seeing slowing growth globally, largely on the back of some trade disputes as well. But the behavior in the high yield market over the last few years has continued to be, let us use this low rate environment and access to capital to refinance at ever lower rates, push our maturities out into the future. Very rare at this stage in the cycle to see still 65% of issuance being used for refinancing and only about 25% used for really aggressive activities. I'll leave comments on the health of the loan market to my colleague, Roberta. Roberta and I started working together 18 years ago. So we share a lot of views, but luckily we're divvying up the asset classes, and high yield is a little bit easier to talk about than loans in this. One thing I would actually take on from Professor Altman's comments, the question of when we do reach a recession, going to be longer and deeper. I don't dispute the longer. I might take the other side of the deeper, and part of what we've seen in the buildup of leverage in the high yield market is it's not these concentrated mega LBOs that we saw in the last cycle. It's leverage spread across a range of industries, including ones that have good asset protection, relatively projectable cash flows, in some cases recession-resistant cash flows. And again, with the refinancing cycle we've seen, my expectation is that we will see steadily higher defaults over the next few years, but not likely a near-term spike to the 10% rate that would force spreads out to the 1,000 basis point stress level.
You guys are really smart. It's hard. So when in doubt, you say Howard Marks. You tell people what Howard Marks would say. And he said, proceed with caution. So, but I think to provide some context, if you go back to 2007, the risk was fairly concentrated among 7 or 8 banks. And I was sitting at Deutsche, and then I moved to Goldman. In the large LBOs, it was very easy to actually predict the downturn because we were all sitting on massive commitments for large LBOs. The challenge today is the risk is much more spread out. And it's much harder to see when and where. It's almost like a tsunami that starts in Asia, and you wake up, California's on the water, and you're like, how did that happen? And I think volatility is one thing people talk about. The velocity and change in our markets is much faster than it used to be. And so today there's cash. Today I'd argue there's not even really that much liquidity. There's a lot of capital. There's not much liquidity today. And so if you fast forward to some volatility in the market, the velocity and change in our markets will be that much faster. And I think the illiquidity in our market, which is actually not very good today, will be pretty bad whenever that downturn actually hits.
Yeah, and I would say that the excesses all seem to be in the corporate loan market, and I think the comments from the previous panel are very accurate. Where we think at Pretium that we are in this cycle is definitively towards the end of the cycle. and we've already started to see the dispersion in returns across cycles, across industries, and we think that that's going to become more pronounced as we go through the next several years. We think this is going to be a very different market than 08, 09, where it was really systemic risk that created a very sharp, short cycle and recovery. I think this is going to be a longer cycle, and I think it will be deeper in certain sectors. I'm of the view, and I think we at Pretium are of the view, that there is not a sector out there right now that is not going through some form of disruption. And in the corporate loan world, the biggest sector in the loan index today is technology. It is 15% of the loan world, and the majority of it is B3 rated. I completely agree with Millwood's comments about the volatility and the lack of liquidity, which the previous panel discussed. We've already started to see the harshness of how quickly loan pricing and bond pricing can drop. And the example this week is a company called McDermott, a big public company in sort of a derivative of the oil and gas space. They made an announcement last Friday. The loans were already a little under stress, but in the course of 24, 48 hours, the loan was down 35 points, and the bonds were down basically something similar. This is the largest loan, hasn't defaulted, but the largest loan that we've seen be impacted by this type of price movement as we sort of move through this cycle. It's a $2.3 billion loan that's broadly syndicated, and it's held in basically every CLO out there. I think this pace of volatility, the lack of liquidity we've seen this week as a result of the sort of big questions around the credit, is just sort of the tip of the iceberg, and I think we're going to see more of this. That being said, we've also seen the contrary to this. The previous panel had an example of J.Crew. I do think that there is certainly degradation in corporate documentation for loans that's been moving one way for the last 10 years. I don't think that it necessarily means that recovery rates for all loans are going to be at 65 or 75 cents. I do agree that it's going to be lower than it was in the last cycle, but I think the dispersion of outcomes is going to be something we've never seen before. And ironically, the J.Crew example, where the IP was actually stripped out, that loan's in the 90s. So I think the environment we're going to be in for the next several years is one of stock picking, credit picking, fundamental bottom up. I think we've been in a world for the last 10 years that's sort of one-way beta related. We're entering a very strong alpha potentially generating world. And I think the dispersion among managers and those of us that manage assets is probably going to be the widest over the next 5 years than we've ever seen before.
I think just to augment, both of you said on the definitions and the leverage, and so what we're saying out there is leverage isn't as high as it used to be. The problem is the definition of adjusted EBITDA is massively more pronounced, and so no one really knows what the leverage is of any credit out there and so when you say something 6 times what? How did you get to 6? And then when you say debt, Are we including cap leases? Are we including pension obligations? Like, and so no one really knows where something is levered until it starts declining, and then you look at the docs and you're like, oh wow, they can do that. Oh wow, they can do that. Oh wow, they can do that. So I think credit selection is going to become, important. It's also hard today, just based on definitions, to truly analyze the credit.
And I hate to pile on, but there's one thing that hasn't been said about the evolution of the leveraged loan market in the last decade, and that is the increase of corporate structures that only have loans outstanding and don't have a subordinated bond outstanding. Every panel has said one of the beauties of leveraged loans is it's senior secured, implying that you've got a claim on the assets, but also implying that somebody else is going to take a first loss. In the last 10 years, the bank loan market has increased in size by 60–70%. The number of issuers has increased by 60–70%. In that period of time, 400 net new issuers in the loan market, 400 net new loan-only issuers in the loan market. So if one of the questions is recovery in the event of default, and if historically loans have recovered 70–75 cents and bonds have recovered 35–40 cents, well, bonds recover less because they take the first loss there. If there's no bond there to do that, I think it justifies a much lower recovery and also greater volatility in the bank loan market going forward.
Roberta, since we've been subject to a lot of discussion around CLOs. Do you want to talk about CLOs in your view? I mean, historically, the asset class sailed through the financial crisis. Their default rates, correct me if I'm wrong, AAA, AA hasn't had a bit of loss. Down the capital stack, compares very favorably to underlying corporates and single name corporates. And yet regulators are talking about it, policymakers are talking about it. Feels like there's a whole lot of misinformation out there. Do you care to clear things up?
Yeah, so I found it very interesting, the question that came at the end of the last panel. And I think there is a lot of, it's a very complex asset class, and one that I think is, largely understood. So, as Van said, there was, through the financial crisis, I think there was only 5 or 6 double Bs in every CLO that did not fully return 100 cents on the dollar. So, and just as a very basic, so that we're all on the same page, CLOs are special purpose vehicles that buy corporate loans, a very diversified pool of corporate loans, generally about 125 issuers, and they have to be diversified across industry. And against that, we issue various tranches of debt. And as the previous panel said, there's about 10% equity supporting that debt. 2/3 of the structure is AAA rated, and that is normally placed with the large banks, be it here in Europe or, and this has gotten a lot of press over the last year, in Japan. The mezz, which we refer to as the triple Bs and double Bs, that's about 10% of the structure in total, and that's largely placed with asset management firms, hedge funds, tends to be a little faster money. And then the double As and single As are really placed with insurance companies. So the AAA through single A is really buy and hold, placed in large institutions, and there's never been a dollar of loss against any of that capital. I think, and the equity, at the end of the day, over what was probably the most, well, was certainly the most volatile credit markets in history, returned on average over 20% annualized across most of the vintages that were issued. What's different today, I'd say the CLO market is probably twice the size, and the equity supporting these CLOs is very long-term in nature and held across pension funds, banks, insurance companies, and is, for the most part, locked up in long-term structures. That being said, CLOs are structured to withhold default rates on an annual basis of about 2% with 75-cent recovery rates. So what is the big question mark around how these deals are going to perform over the next several years is what is going to happen to that default rate. It can sustain sort of a spike, but it needs to come back, as we saw in 08, 09, pretty quickly. And recovery rates, while the loan market priced itself down to 65 cents, CLOs are not forced sellers. So that was a question previously. These are not mark-to-market vehicles, and they are not forced to sell under any circumstances. They just reverse where you stop paying your equity and you start paying down, deleveraging the structure. That being said, I think we today have 140 different types of CLO managers out there, and I think the expected returns of the equity across those different managers is going to be very different. And I also think the double Bs, which I think I'm accurate in saying there were only 7 deals in the last cycle that lost any principal, I think could be more impacted as we go through this cycle. And this time around, it's really going to come down to your manager, the team you have managing those assets and assessing the credits. And the other big difference is that in the pre-crisis, you had 7 years to reinvest. This time around, they're shorter deals, and you might not have that length of time to let the market recover for you.
Vishit, you have a view?
Of course, I have a view. I would say, I'm part of publishing research.
That's why you're here.
So I'm required to have a view. I would characterize I wouldn't quite characterize that CLOs sailed through the crisis. They did, as Roberta just said, they did, if you measure from the perspective of, did they take an eventual loss? Or what proportion of the outstanding CLO tranches took any loss? You're right? But if you take the perspective of what happened to the market of these, to the holders of these tranches, a serious amount of, vast majority of the CLO equity tranches were, single-digit cents on the dollar. They saw that. The CLO AAAs, I remember being, 65, 67 cents on the dollar. So if you take from the perspective of what kind of a mark-to-market pain the investors that were in experienced, it was a rocky time.
So safe to say that this is not widely traded. Right?
It's not widely traded.
Trade by appointment. It's
not widely traded. There's an important thing to recognize here. What contributed to the outperformance of CLO equity. CLO equity did have, on average, 20% return. I would say over this period, meaningfully outperforming, S&P 500 returns. How did that performance? What led to that performance? I would identify there are many reasons. I would identify just 2 of them. One is that starting around 2009, 2010 period, there was the introduction of Libor Floors. Libor Floors were effectively, because the interest level of Libor was so low, to incentivize investors to put money in loans, it was just the spread was not enough. So you needed, if Libor is 0 plus 400 is just 400. So to get people, their introduction of Libor Floors, and Libor Floors initially started around 2.5%. Why does this matter to CLOs? When CLOs are reinvesting vehicles, and loans in the asset side of the CLOs had progressively started with a relatively small amount of Libor floors. Over time, 90% of the assets in the portfolio had Libor floors. And liabilities, CLO liabilities, didn't change. They are the same liability structure. The CLO AAA through BB, they didn't have any Libor floors. And the cash flow mechanism is such that the excess spread in these deals, once the all the debt tranches are paid, just goes down. So to put some numbers here, so if we had a Libor floor, say 2% Libor floor, and the equity was levered 10 times or 12 times back in the day, you had basically the excess spread of 2% getting massively levered once the issues, the OC tests, et cetera, cured. That brings me to the second point. So this is a big difference. We could have a world where we might see a return on Libor floors, but the Libor floors contributed massively to the very substantial, healthy returns that we saw for CLO equity. The second important thing is the shape of how the default cycle evolved and why it evolved the way it did. So we saw, 2008, June of 2008, a few months before Lehman, leveraged loan defaults for 2% under 2%. And then we saw the financial crisis explode, and defaults spiked very dramatically, bellowing into double digits. And then came this boatloads of policy intervention. HARP, TARP, TALF, PPIF, QE1, I'm sure I'm forgetting many of the acronyms, but there was massive amount of policy that got thrown at locally in the United States and globally. As a result of that, we saw a very fast recovery. By early 2010, default rates were down to 3% type of levels, long-term average kind of levels. So what did it do to CLOs? What it did was deals that, as defaults started happening, you had a certain test breach, equity cash flows were cut off, but they didn't stay cut off. On average, CLO equity tranches were cut off for 2 to 3 quarters. And 60% of the CLO tranches did experience a cutoff, but only for a relatively short period of time. It's because recovery was so quick, the cash flows reverted with the benefit of Libor floors. And that was a massive, so we need to see, if we think that the shape of the default cycle next downturn will be different, if we look more like the late 90s default cycle, where it was a slow, gradual pickup in downgrades and defaults that extends over a 4 to 5 year period, the outcomes for different CLO tranches will be very different.
Right, so Vich, I guess I probably know the answer, but in following on Darryl Duffy's comments today, so I'm guessing you believe that if we go into the same sort of financial market-driven shock, that you're not going to see all those acronyms reappear. Is that a fair statement?
I would put the probability of a lot of that policy, either both the availability of all those policy tools and the efficacy of those policy tools to be much, much lower.
Yeah, I would agree. Let's shift gears a little bit and get to another big issue that we all sort of talk about in the structure of the market, and that is sort of the BBB problem, right? We've talked about it today, and I think Oleg sort of gave us some data. BBBs are 2 times the size of the high yield market, right? So Ed earlier talked about a crowding out effect, and that's the issue that I think all of us are sort of looking at. It's a bit abstract now until it sort of isn't, right? So Rachel, do you have a thought on sort of the BBB problem and how much of a problem it really is?
Yeah, kind of the theme of a lot of my comments is it's different this time in a market where people like to say, well, history doesn't repeat, but it often rhymes. It's not rhyming as well this time, and in the case of today's BBBs, it makes us feel somewhat more comfortable. So if you think about the fallen angel cohorts that we've seen in the last couple of downturns, they were banks falling into high yield in 2008, 2009. Well, if you're a bank and your cost of capital shoots up to high yield levels, you're no longer viable. So this is a classic falling knife that nobody wants to catch. Similarly, in 15, 16, you had metals and mining and energy companies, deep cyclicals whose commodity prices were collapsing, their enterprise values were collapsing. People could easily see a path to zero recovery, so nobody wants to catch those falling knives either. Today's BBBs, we think, are different from those cohorts. It's largely self-inflicted through M&A or dividends and share repurchases, generally a sense that the optimal weighted average cost of capital is somewhere in the BBB, BB cohort. So you're doing the best by your shareholders by going to a BBB rating. But these companies are largely in media, telecommunications, healthcare, health insurance, consumer products, and the like. So as I was mentioning earlier, these are not only companies that have somewhat more stable asset values, enterprise values, and revenue and earnings streams. These are also companies that frequently have disposable assets that they can sell to delever, they can turn off dividends and things like that. And then the final point is these are credits that actually high-yield companies wouldn't, high-yield investors wouldn't mind owning if they came into our universe. The concern being that BBBs are now twice the size of the high yield market, and so any meaningful downgrade would just change the shape of the market. This is true. We think investment grade investors are much more flexible these days than they have been in decades past at continuing to hold downgraded credits if they like them, so a little bit less of a threat. Also, if you remember from Oleg's chart, net outflows from high yield actually since 2014, which was the peak of this cycle. So at the moment, it is not a massively over-invested asset class. You've actually seen a shrinkage of high yield. We think that there is plenty of capital out there that at the right valuation is interested in coming in and buying good quality corporate credits. I think one of the things we've seen in the financial crisis in particular is that there were a lot of levered investors in the high yield market who were then forced sellers when their leverage was unwound on them. The market feels much less levered at that level this time round, and we know of lots of deep pockets of dry powder that are looking for higher yielding opportunities. All this to say, it doesn't mean there won't be dislocation as credits fall. One of the latest stories is Ford. Is that going to be back in high yield? They fell into high yield in 2005. Round trip again, maybe. They've got operating challenges. Auto companies can have some pretty deep cyclicality to them. So it's not all roses, but I guess I'm just trying to put the positive spin on a big challenge.
If we go to the negative spin, I'm guessing, Vishy, that's you.
I can help on it. The one thing on BBBs in the last cycle, Libor was what, 5%? Coupons were higher. And so coupons are much lower today. And for distressed investors to get excited or interested in those names, the price degradation has to be much steeper relative to the last downturn. So that could drive the volatility.
Agreed.
And just a quick market observation between BBs and BBBs. BBBs trade relatively cheap because people are worried about the size of the cohort. BBs are at sort of 90 percentile rich, and so the relative value between the two of them is very, very tight. And the yield on your typical BB right now is about 4.5%.
I agree with you on that. You might be surprised, but I would say that the ultimate point we are trying to make for credit investors is that quality, regardless of whatever part of the credit spectrum you are, we think positioning for higher quality is the ideal positioning to be in. So if you look at the basis between BBB, BB, you're not giving up that much by going to BBB versus BB. And you are picking up a lot better. You're also getting rid of a lot of negative convexity that is, we think, is not very appropriately priced in the BB market. Likewise, single A BBB, the basis is nearly at an all-time low. So, if you are in BBB, move up to single A, and the sectors that we like, or we think that the leverage has risen across many, many different sectors. The one place leverage has not gone up, clearly has not gone up, and actually meaningfully gone down is financials. And because really of regulatory fiat, leverage has, of more financials has meaningfully lower. And the compensation, the metric that we always look for is what are you getting paid for being a credit investor? How much spread you're getting paid for unit leverage. That metric, if you look at that metric, financial score much, much better. And investment grade in general has lower exposure to cyclicals and, relatively speaking, a better risk-reward profile in our mind.
Let's go back to revisit that world of private credit. Millwood at Oaktree, the quintessential sort of value-oriented shop. I assume you're a disciple of Howard Marks. In this environment, how could you originate anything? Or what do you like?
Oh, there's always something to originate.
I figured as much.
With I don't know if it's 100 or 200 private credit funds that have been formed in the last 2 years. Your first asset of that fund probably was one all the big guys passed on. So there's at least 200 bad deals out there because everyone's done one. But I think seriously, the challenge today is you're not really pricing risk. The availability of capital in our market is so much that you're really pricing capital flow. And the one thing.
What do you mean by that?
So if there's, I'll analogous to a car, right? If there are 20 white Ford Tauruses on the lot, right? If there is only one buyer, the other 19 are worthless, and you only have one that's worth anything. In our market, so what I'm saying is, if there's one deal out there and we're all trying to put money to work, we originally priced it at 6, right, or 8, but we really want that deal and everybody else wanted it, so it becomes 6. And then it gets chiseled down to 2 guys and who really want it at that point, and then it's 4. So the 8% deal is really pricing at 4%. Oh, but we're okay because we have leverage facilities that we can do 70% advance rate on asset and we get back to 8, right? And so that's the phenomenon you're seeing in private credit is that you get more comfortable with where you're pricing it because some of your return is through the leverage facility that we have on the facility. So the challenge is the opposite actually happens in a downturn, right? There's no one doing anything. So not only can you price risk, you get a premium because no one else wants to put money to work. And so what we've been trying to do is almost stay away from the macro and doing deals where we can actually price risk. It's less driven by the macro environment. And it means you pass a lot. It's deeper and cheaper. Everyone wants you to go deeper in terms of leverage, and everyone wants cheaper. So it's okay to be a little bit more credit selective because we think at some point the opportunity set will reverse itself, and we'll be able to put more money to work when the market changes.
Yeah, got it. So I want to revisit the idea of liquidity a little bit, and put it in sort of concrete terms. How do you actually, think about that, and all the warning signals that are out there? Has it changed the way you think about putting the money to work? Roberta, do you have a view on this, or?
Yeah, and I think that the liquidity and lack of liquidity that the banks are providing.
You say, first of all, just for context, is
Yeah.
it really worse today, or thinking prospectively, do you think
Right.
it will be worse than what it was back in 2008 and 9?
It will,
Infinitely.
yes. And we've already started to see that. Yeah. So I think there's two ways to think of liquidity. I think the first is you've bought a bond or you've bought a loan, and is the bank that arranged it and sold it to you going to make a market in it that's, inside a point to buy it back from you when you need that liquidity, when you've had that redemption from a mutual fund, or you're trying to liquidate a portfolio. I think that liquidity is very thin, and it really only resides at sort of in the loan market close to par. As soon as you have any stress in a credit, the banks are basically stepping away, and the immediate price action is basically to a clearing level where they don't get hit. So the banks are providing very little liquidity right now after a credit event has happened, and I think that's only going to become more exaggerated. We've already started to see that. What I think, though, is that we have all set up vehicles to hopefully benefit from that, because this is where the opportunity is really going to reside. And it's started, and I think it's only going to become more pronounced. So I think all of us across the table have long-term locked up capital to really take advantage of these pockets in the market. And I know that on the direct lending side, they've also done this. So evergreen facilities, sort of 7-year. The question is, when do you start? And our view is it's starting now, and it's only going to become more pronounced. I think the other thing, and listening to people and where the pockets are, it's really going to be very disjointed too. So investment grade buyers, triple Bs migrating to double Bs. In corporate world, CLOs and institutional corporate loan buyers are really a single B market. And 40% of issuance in the last couple of years has been at the B3 level. Basically, nobody can buy triple Cs unless you're a distressed shop. So the migration at either end of the high yield market's really going to see pockets of opportunity. And CLOs in particular, which have been, the enormous machine that's been buying all of these corporate loans, they can't buy triple Cs. They have to manage their triple Cs very actively. It's an asset class that is extremely fine-tuned to ratings. And we as a firm think that that's going to set up for huge opportunity to take advantage of that illiquidity in the market.
I think that's the benefit of private credit as well. So if we're the only lender in that capital structure, we aren't subjected to the 50 lenders, and there's one that has a liquidity issue. And to Roberta's point, there is no cushion due to Dodd-Frank, et cetera, at the bank. So if that's a forced seller, it could be down 20 points, which may not really mean that the credit's actually impaired. It was a liquidity issue. And so in private credit, we have quarterly valuation. It's based on cash flows, and the marks tend to hopefully more closely reflect the credit. You'll probably get some movement just on the movement on the market, but it'll be a lot more refined or a lot less intense relative to the public markets, I think.
That's why all the money's coming into your asset class. I got it. So why don't we stop there, and we'll do the lining up for questions. By all means. Yep. Ed?
Before the questions, and thank you for timing, I just wanted to clarify based on Rachel's correct comment. When I was saying that the next downturn will be longer and deeper, what I meant by deeper is more debt defaulting, not necessarily higher default rates, and lower higher LGD, higher loss given default. That's what I meant, rather than higher default rates. Just to be clear.
Yep, good. First question.
Thank you. I'm concerned how we get out of it once we get into it. Arguably, the last time consumers got us in, consumers got us out. How are we going to get out of the next one? Also, it sounds like we have fewer tools available. So even you implied it might be longer, but not deeper. Well, without tools, how deep is it going to go?
Wow, crystal ball moment. It's a very tough question because it is different this time, isn't it? Charlie earlier mentioned the experience in Japan, and at lunch I said Japanification is a really ugly word that I'm spending a lot of time thinking about. Now, maybe the best thing about that is that the expectation that rates are going to stay extraordinarily low will give those that have access to capital a chance to roll their debt. And also that I think we haven't seen the exuberance, the excesses that mean that the pullback necessarily has to be that strong from here. But with the whole world slowing and demographic trends we're seeing, I am very challenged to see the happy ending. I think it's a long, slow process.
And I think that really speaks to why it's going to be longer, and the depth of the cycle this time is really sort of goes to your question, and can the U.S. consumer bring us out, right? Exactly.
Yeah, but I'll sort of add in, with the world in disarray, right,
Yeah.
another significant headwind to try and think how all that's going to get solved and not complicate the problem. Over here.
I've got a kind of narrow technical-ish question, but it's also about politics. Okay, so if you think the outcome of the next election is 50-50, it could go either way. That still means a substantial probability that the technology, healthcare, and energy industries are going to be subject to policy attention, right? And I was struck on Oleg's chart that those are kind of pretty big exposures in the market. So my question is this already priced in, or are people not thinking ahead about that?
Who wants a politics question?
So, I mean,
Yeah.
I'm not touching it.
I'd say, I think of it as an industry question, but yeah, it's political too. I think that, no, I don't think it's priced in. I think, and this goes to my comment of, I don't think there's an industry out there that's not going through some form of disruption. And I recently wrote that, the classic defensive sectors that we would be, in particular in high yield, rotating into aren't. So that's healthcare, cable, we're going through cord cutting, telecom, going through massive disruption. But what you can do, and this really goes down to manager selection, is you can be defensive within each of these sectors. The one that concerns me the most is technology, which, as Millwood said, you don't know what the EBITDA is. They're all hugely adjusted, and they're all B3. So, and the docs they're all LBO driven. So, that to me is is going to be the big differentiator in the loan world. It's 15% of the loan index. Healthcare is 10%, and energy is less relevant in loans, but.
Yeah, I mean, with every poll that comes out, starting sort of now, right, you're going to start to see, I think, this is going to flow into eventually it's going to get priced in, and it's probably not going to go the right way. Vishy, any thoughts on that?
Well, I think either, regardless of the outcome, I think we might go down the path. There is going to be policy uncertainty of various sorts that, regardless of which party comes into power. And I think that's in our mind, it's not priced in, but it's one of the reasons why we think, why we are more bearish on risk assets at this point.
Again, my theme of things are different this time. I think Democrats are different than they used to be, and Republicans are different than they used to be. So actually, I think fiscal responsibility may have shifted across the aisle a little bit and should be reflected in the election. One hopeful sign of a possible Democrat win is if we unwind some of the tariff or at least stress between us and our international trading partners. That may help reaccelerate the manufacturing sector. And while our current president said he was the big deregulation guy, healthcare has still gone through a pretty major wave of scrutiny and regulation over the last couple of years and is currently grappling with surprise billing and pharmaceutical reimbursement. So there are thematic things, but it's not as black and white as it might have seemed.
Yeah, good points. Over here.
My question is related to the institutional buying of the single-family homes. What are your views on the structures and, in the long term related to the asset price?
Sounds like Roberta.
I guess that's me. So, and this is, I should give a little bit of background. So Pretium was started in 2012. The founder of Pretium is a fellow partner at Goldman Sachs who ran the mortgage and corporate credit department at Goldman. He started Pretium with a fund that basically went out and bought single-family rental properties. And I think the first fund bought 20,000 homes, and today we're in the midst of launching Fund 3. And Pretium today is the largest single-family rental owner in the U.S. And we are extremely optimistic about single-family rental, and basically are buying at a pace of 1,000 homes a month. It's less about the purchase price of the homes. It's all about sort of the, as you would expect, location, demographic, schooling districts. But we have seen tremendous success in that asset class, and believe that it's got years to run. Yeah.
Yeah, I totally agree with that. We think we've gone from a home ownership rates of 69% to now hovering around 63.8%. We are going to be in a, thanks to the millennial generation, we are going to have a very steady household formation. That household formation is not going to, it's going to be a demand for shelter, not going to translate into demand for ownership shelter. So we think what this means is a ownership to rentership transition is here for to stay, and we think there is a secular rentership phenomena, and institutional ownership of single-family homes. Clearly Pretium is a leader here, but institutional ownership is still a fairly small portion. There's a lot of growth opportunity that's still remaining here, because most of the single-family rental market is owned by mom and pops. It's not owned by institutional investors yet. I mean, it's very far to go.
And I would say, I think there are three institutional acquirers that we are sort of in the universe with, and all are sort of experiencing tremendous growth. The capital behind us is institutional in nature as well, but we see lots of sort of runway in terms of the opportunity, as Ash said.
Last question.
It's about investor interest in CLOs right now.
Yes.
Which investors, which tranches, and also the change in interest rates, to what degree were these marketed as suitable or appropriate for a rising interest rate environment? Now that that's no longer the case, has that diminished the appeal to investors? So it has nothing to do about the opportunities you see. It's purely a market sentiment question.
Yeah, so basically, these are not sold as interest sensitive products. So the way a CLO works is your assets, so the loans that you acquire and generate income for the CLOs, those are based off Libor today. Today the average is Libor plus 350. And your liabilities, the 90% of debt that you go out and raise on average, and it's been swinging around, but is somewhere between Libor plus 190 and Libor plus 200. So let's, for argument's sake, it's L plus 200. That extra 1.5% goes to equity. It's day one cash is 15%. So at a very basic level, if Libor goes up or goes down, it impacts both your assets and your liabilities. The timing mismatch can be impactful when there's big swings in Libor, but overall, they weren't sold as products that are benefit from rising rates. Bank loan mutual funds, which have seen 43 weeks of outflows. I think this week we finally had one inflow. Those are generally sold as senior secured and benefit during a rising rate environment. As soon as rates looked like they were going to go the other way in December and we were going to go into a rate cutting environment, that's what the trigger was for those outflows over the last year.
Okay, with that, I think we'll wrap up this session. Please thank all of our panelists.